Welcome back, and you're still tuned into Markets at Noon on ET Now. And Diwali is round the corner, and to get a sense of what Samvat 2082 will look like, to discuss exactly this, we have a very special guest joining us here on the show in our studios today, Ashish Somaiya, CEO, Vito Capital AMC. Sir, thank you so much for taking your time out and joining us here on ET Now. And we have to start by asking and discussing about the Indian economy, which continues to remain resilient. But if we look at equity markets, we have underperformed several global economies. What's the outlook for the next Samvat? Should we perhaps moderate our expectations?
I think the beauty about markets is always that, if you don't go anywhere for a year, then automatically you get 12 to 15% cheaper, right? So that is something which always gives comfort. Starting point for this Samvats in that sense is better than probably the starting point last year that we know now. The second important thing is that, if you really ask me from now, this Diwali to next Diwali, I would break it into two parts. And I would say that, look at the next 3 to 6 months as the first half and then the second half. I think next 3 to 6 months is going to be more of what we are witnessing, right? I mean, uncertainty because of external environment, uncertainty because of US tariffs and geopolitics and stuff, correct? And then maybe at some point in time in the second half is when you will see things settling down. The other important thing to watch for is not just domestic. Like you said, domestically things are improving. But somewhere, if you see in the US economy, the US markets, I think those concerns are rising, right? So I think we need to see some time pass by and we need to see some of those issues settling, because even as our conditions are improving, the external environment is not allowing our market to do too much. So maybe next 3 to 6 months is more of the same. And then I think we'll cross the hump and second half will look much better.
Okay, and while we're talking about domestic triggers to watch out for, the next big one now, and it's actually underway, is the earnings season. Yeah. While we've just had select IT names so far, what's your take on the overall earnings season? Because we've had this GST push that, we might have to wait a couple of more quarters to see that impact. But as of now, what is your outlook on where quarter two could be shaping up our economy going ahead? And could it be better than the numbers we've seen in quarter one?
Yeah, see, I think look at it this way. Since we are talking Diwali to Diwali, let's say last year, 1 year back, same time, we were talking 5.4% GDP growth and practically zero earning growth. Now, from there, we've not moved a whole lot. I mean, overall GDP projections are, say, more like 6.5 what World Bank projected. Fitch projected maybe higher, 6.9 or something. And earnings are obviously not zero, but they are still not where we want them to be, maybe say high single digits kind of thing. And what I've seen, most people expect this year to end at high single digits. But maybe FY27 could be low double digits like 12-13%. Okay. So I think all in all, we just have to hope for this trend to continue. I don't think that, given the way things are, I mean, it's all a mixed kind of picture, right? You have taxation, you have GST, and maybe you have 8th pay commission coming up, right? So all of those things may add some tailwind to consumption. But overall, I think if we can just see a steadily improving trend, and if we are likely to see positive commentary, we are likely to see a steadily improving trend. The other thing which I am quite hopeful about is, if you really see when RBI policy comes, everybody speaks about, interest rates or liquidity. But you can clearly see that the talk is becoming a little bit aggressive in the sense like, relaxing, pulling out all stops in terms of credit policy, in terms of being the ability to lend or the ability to raise money through ECBs, etc. Because, I think last 10 years, the whole system has gone through a cleanup. And people have been very, very conservative when it comes to their balance sheets and expansion. And I think, but now the cleanup is behind us, and maybe the government as well as RBI is kind of trying to engender like an expansionary cycle. So not just consumption. I think overall we need to watch for growth in credit. We need to watch for investment picking up. So next couple of quarters, I would say next couple of quarters are important to watch for. But I have not seen much to say that we are going to see some, sudden, blowout kind of performance. I think the overall picture is mixed. We are just looking for improving trend.
Sure. Okay, so that's as far as consumption is concerned. But sectorally, any particular sector that you're watching out for, and any sector that you find value in given the current valuation?
So, what is happening is that, I mean, assuming that a lot of our listeners, they invest in mutual funds and they invest in, equities. What happens is that if you see in the recent times, there is no clear winner. Even if you look at the mutual funds that we manage, you can clearly see that diversified funds and the guys who are bottom-up stock pickers, identifying relatively better ideas across sectors rather than focusing on any one or two sector. I think the diversified strategy seems to be working much better. I don't think that will change at least in the next 6 to 9 months. I personally don't find any clear trend that, okay, is small cap going to do better than large cap, or is XYZ sector going to do better than ABC, correct? So that said, just, due respect to your question, I would still say that the real change seems to be coming in the banking side of things. Cliched thing to say, but if what I just spoke in the previous point, if that is actually going to play out and we're going to see like an expansionary cycle and credit offtake really increasing, then the things for banking will actually change significantly. If you see consumption, yes, but maybe select pockets of discretionary, and there also it's not like things are available dirt cheap, correct? It's like, some of these things are anticipated. Discretionary consumption or overall consumption has anyway been on a significant ramp up. The third thing is, if you ask me, the wider, manufacturing environment. I mean, in the past, people have spoken a lot about defense or defense indigenization, but I'm talking more the broader manufacturing space across sectors. The fourth one would be, if you ask me, everything which is import replacement, like chemicals and those kinds of things.
Okay.
And lastly, I would say that, tech also, the broader tech sector, I think is a good contra play. Because a lot of, generally one would look for at least some contra indicator, because today if you see people who don't have much to do with the market, from a distance itself they'll tell you that tech is not the place to be in. A good contra indicator is what I would say.
So time to be bottom up right now?
You have to be. I think
Yes.
that's what I meant by saying that there are no trends.
Yeah.
And it's better to look for relative performers in every sector rather than really putting so much time behind trying to find a clear winner.
Okay, and you've also spoken about the mutual fund data and the SIP data this time around. Record high numbers coming in, 29,000 crores is something that we've crossed for the first time.
Yeah.
On the flip side, you have markets that continue to be stagnant for many months. Does this indicate that investor confidence is still quite steady in the market, even though it's coming via the SIP route?
So, definitely. See, what I've seen over the years is that at every point in time in the market, there'll be cohorts of investors. So at every point in time, there are some investors who have seen one market cycle, two market cycles, three market cycles. In every market scenario, there'll be some people who feel that, okay, this is how it works, nothing to be worried about. And there'll be always some people who say, oh my God, I started 1 year back, I put in 12 installments, it's going nowhere, right? But on balance, I think there is now a critical mass in the industry because we are nearly 6 crore unique investors. So on balance, I would agree with you that there is a critical mass of people who now understood that, okay, this is how it really works. Second point I would tell you is that since there will always be some new or young investors, you should keep in mind that if it continues like this, you will see some people throw in the hat and get disappointed because now it's a year. In a year, you put 12 installments and you find that the value is, let's say, where it was or a little bit lower than where you started. And these are precisely the times when people get these kind of thoughts. Oh, if I'd left money in the bank, it would be better. Or instead of equity SIP, if I would have done gold, it would have been better. This is when the regret kind of starts to set in.
Yes.
Yeah. So there will always be some people who get disturbed. But on balance, yes, there is a critical mass now who is kind of persisting.
And since you represent the AMC industry, for an investor who wants to make lump sum investment or even SIP for that matter, which metric do you think is the most important one? And if you can tell us, why is information ratio very crucial?
So, today, so first of all, if today somebody is doing an SIP, I would tell, jumping in right now, I would say not to do lump sum, stagger it over 6 months. And that's the sense you get from the conversation, that we are waiting for trends to improve and we are waiting for external macro to settle. I think information ratio, great point you brought, it's the most reliable kind of indicator, right? Because one of the key challenges for anybody investing in mutual funds, you must have noticed yourself. The problem is that every second year or every alternate year, the best performing fund manager, fund house kind of tends to rotate.
Right.
So there are times when somebody has very high alpha, but it is inconsistent. So 1 year you find somebody on the top, couple of years later, back.
Right.
So the key is not to have high alpha, right? In last 5 years, I may show high average alpha, but you might find that in the last 2 years, I have a high alpha, and before that, 3 years were disaster. So 2 years of good performance has pulled up my 5-year average, whereas there is a large number of investors who did not get positive alpha. Only 1 or 2 years of performance has pulled it up. So when you look at alpha, what is more important is the consistency of alpha. So information ratio is a great indicator, and kudos to SEBI because they made it mandatory for all mutual funds to disclose it starting April. Because information ratio is basically alpha, which is your outperformance over benchmark. So that's your numerator, alpha divided by the standard deviation of alpha.
Right.
As in alpha divided by the variability of alpha. So, in cricketing terms, if let's say there is a batsman who has 45 runs as the average score, correct, and there's another guy who has say 40 runs as the average score. The guy with 45 on the best of days scores 200, but then has a string of ducks. And the guy with 40 as an average on the best of days makes 100, but even on the worst pitch will at least give you a start and make 20-30 runs. So clearly the guy with 40 average is much more reliable than the guy with a 45 average. So information ratio in that sense is a great indicator for consistency, and people will stay put with us if we are consistent, right? If you are like sometimes Jannat, sometimes Jahannam, then people can't stay invested. So consistency is critical, and information ratio helps you to gauge that.
Okay, interesting conversation and lovely example you've given over there. Cricket analogy, I'm sure our viewers, understand this analogy the best. Cricket,
so.
Of course. We're a country that loves cricket. But thank you, Mr. Somaiya, for joining us on the show and great insights, and look to chat with you very again soon.
Thank you. Thank you very
so
much.
Okay, on that note, viewers, we'll slip into a very short break and talk more about markets on the other side when we return.